markets. This is chapter 4, and I'll talk you to the subjects I want to present to you. At first, the chapter is divided in more paragraphs, but these are the subjects that I like to present to you. They seem most important to the chapter. So first is primary markets. I'm going to tell you a little bit about that. Then there's how to trade securities. How do we trade securities? Then there's the different securities markets as well in the US as other countries in the world. Then I'm going to explain you a little bit about buying on the margin. After that, short sales, which is almost the same, and I'll explain how it works. And then a little bit about regulation. Not my favorite part, but it is in the chapter, so I'll tell you a little bit about it. At first, primary markets. So, as you can see, investment banking, that is about public offerings of both stocks and bonds, typically are marketed by an investment bankers, who in this role are called underwriters. Okay, there are two types, and the two types of primary market issue in common stock, that is initial public offering, IPO, or the seasoned equity offerings. So the IPO is simply explained, if you have a private owned company, you go to the stock market and the first launch you make on the stock market is an IPO. Seasoned equity offerings are done by larger companies that have already floated equity before, and this could be, for example, IBM. Another important part about the primary market is a prospectus. So a primarily registration statement must be filled in with the Securities Exchange Commission before you can launch equity on the stock market. So when the statement is finally in form and approved by the SEC, it is called prospectus, and at this point the price at which the securities will be offered to the public will be announced. So that's very important. And another way to issue securities is about private placement. And private placement, the word explains itself a little bit. Private investors will come in and try to, together with institutional investment companies, and they will buy a large amount of stocks, of new primary market stocks from a company. This can bring, this brings a little bit of extra forward. It's not just the difference between a large open market, an initial public offering, or the private placement. Is mostly the private placement is also cheaper, because the statement that is required with a public offering is not required for the private one, and also because private placements do not trade in secondary markets of stock exchange, which means that they are probably owned for a longer time by one person or by one institutional investor. So, then we have 698. Could anybody tell me what this means? Does anybody have an idea? 698. What if I say you 698 is a percentage of profit on a first day return? Sounds good, doesn't it? That means if you invest 10,000 won today, you will get 6,980,000 won on the end of the day. That's pretty good. And that is usually what happens after the book building, when a company launches into the initial public offerings. So this is an extreme example of a company called Linux, which was launched in December 1999. But in the end, underpricing seems to be a universal phenomenon. So if you're interested in making money and you want to buy stock at an initial public offering, so for the first time that stock gets released, then it's always interesting to look at the prospectus. And for Korea, if you look in the book, you can see figure 3.2. It shows that Korea has a 50% profit on the first day you buy the share. So that's pretty interesting. Take a look at it. Then we go to trading securities. And we have divided that in, the book has divided that in markets, orders, and trading mechanisms. So I'll talk you through that. We have different types of markets, 4 different types. That is direct search markets, brokers markets, dealer markets, and auction markets. The direct search market, it explains itself. Buyers and sellers must seek each other out directly. The brokers market is an important investment market in the primary market, and is also another broker market of large stock transactions, so large blocks of stocks being traded. Then the dealer markets, when trading activity in a particular type of asset increases, dealer markets arise. Dealers specialize into various assets. And the last one here is auction markets, and that's the most integrated market. Everybody knows this. A good example is the New York Stock Exchange, the NYSE. So then we come to orders and types of orders. We have 2 types of orders. We have the market orders and we have the price contingent orders. Very simply said, it's market orders. If you want to sell at a current price and you execute the order, it will be executed immediately. The other one, the price contingent order, puts in a limit. So you order on forehand and you say, I want to sell my share at around $120, and when the share reaches $120, it will be sold automatically. Then there's trading mechanisms. We have 3 kinds of trading mechanisms. That's broadly speaking for the US. So there's the dealer markets. I'll just read it up. Roughly 35,000 securities are traded over the counter or OTC market. Thousands of brokers register with SEC and security dealers. Dealers quote prices at which they are willing to buy or sell securities, and a broker then executes the trading by contracting a dealer, listing an unattractive quote. Dealers markets are quite important, but I think the next one, electronic communication networks, are far more important and will be even more important in the future. Electronic communication networks allow participants to post markets and limit orders over computer networks, and that is done so automatically, so it makes the world far more easy. And the last one are specialist markets, and that is simply brokers who wish to buy or sell shares on behalf of their clients must direct the trade to the specialist post on the floor of the exchange. They get a lot of competition from the electronic communication network nowadays, so we'll see what it does in the future. Maybe the professor could tell us more about his vision about this subject. Then I'd like to go to the next possibility, which are the different securities markets. As you can see, we have the US markets, other countries, and we have one important point in this paragraph, which is called globalization. The different US security markets are simply NASDAQ, the New York Stock Exchange, and the book pretty much explains the basics, and I think everybody knows quite a bit about how it works. If you have any questions, you can read it. It's very easy. It's a light chapter or a light paragraph to read. So I would like to talk a little bit about other countries. The book quotes London, Euronext and Tokyo as very important markets. And because I am from the Netherlands, I'd like to tell you a little bit about Euronext. Euronext was formed by a merger of Paris, Amsterdam and Brussels exchanges, and is now cross-trading with several other European exchanges. So it has become a pretty big market for us in Europe to trade on. London is the other one. I prefer Euronext myself. It's a good market. Definitely. Sorry?
Where is the exchange for you?
I believe it's in Amsterdam. I'm not 100% sure. It could also be divided in Amsterdam and Paris. So, because Paris is the larger one. I will search that up for you and tell you the next time. The last thing I would like to talk to you about is globalization and consolidation of stock markets. All stock markets have come under increasing pressure in recent years to make international alliances or mergers. And there are three good reasons for that. Much of this pressure is due to impact of the electronic trading. It becomes more important for exchanges to provide the cheapest and most efficient mechanism by which trades will be executed and cleared. Another one is eventually we need a 24-hour global market. And the last one is companies want to be able to go beyond national borders to sell their shares on new markets. Very important. So if we look at that, we arrive at our next subject I find really interesting, buying on a margin. And the best way to explain this to you is by showing you the example that's also in the book on page 69. You can find the book page 69 somewhere halfway the page. So what we have is we have an IBM stock for $100 per share. We will do an investment from our own equity of $10,000. We will have an investment loan from a broker of $10,000 as well, so 50-50 divided equity buying, as I like to call it. And that by a margin loan of 9% per year, so the total investment is $20,000 for 200 shares. And we expect that the share will rise this year with a 30% profit. That sounds good, doesn't it? So if we make the calculation, we've got 200 shares times 130% is 26,000. 26,000 minus the 10,900, which is of course the money we got from the broker plus the equity interest rate, gives us $15,100 remaining. And if we put that into practice, how much profit do we think we have? Quite an easy calculation. That is a 51% profit from a normal 30% profit, which is good. Very good, isn't it? If anybody knows a company that will rise 30% in the next year, please let me know. And we're going to try this out. On the other hand, what do we have when we get a 30% loss? That's a different story, or is it? We've got 3,100 left. If we have a 30% loss, and after paying back the brokers, I lost the English word, the margin loan and the investment loan from the broker. So we have $3,100 left, and if we count that up, we have a 69% loss, and that is painful. So I think that's the easiest way to explain it to you. Does anybody have any questions about how this works? I would like to do another one for you or explain it again. Anybody? That's good, that means it's very nice. Then short sales. Short sales, I found myself always figuring out how do short sales work. The books I used normally in the Netherlands were not as convincing as this book is. This book is very clear on how it works, and I find it very easy to understand now, and it is very easy. There's nothing difficult about it. What you do is you first sell and then you buy the shares. You say, how can I sell my shares if I don't own them? That's difficult. But it's not, because your broker will sell the shares for you, and you will have sort of loan with the broker. The thing is, normally when you sell a share or sell equity, then you have the money to invest it further on. But in this case, because it's a very risky investment, the broker will hold that money for you until you sell the short sales, or until you buy the short sales, and until you clear your short sales out. So the formula for this is the profit is the initial price which you pay what you receive when you sell the share to the broker, minus the ending price, plus of course dividend if there's any involved. Then we have the last part, regulation. And in regulation, that is a very, a lot of talks after the financial crisis have been going on about regulation. And to me, the most important one that is figured out here is the Federal Reserve. And I'll tell you a little bit more about it. And then I would like to end. The Federal Reserve has a broad responsibility for the health of the US financial system. And that's why I think it is the most important player in this market. In this role, the Fed is set margin requirements on stock and stock options to regulate bank lendings to securities markets participants. So, if you hold that in mind, the Fed and the news the Fed brings out and what's going to happen in the next few months also about short selling is going to be very important for the future. So keep the Fed in mind. And there's one more chapter, but that will be presented to you next week. So I'd like to thank you for your attention.
Any question?
Okay.
Thank you.
Could you please upload this file to EasyHub?
Yeah.
Okay, thank you. 박주연, could you please explain what term structure of interest means? What is it? You forgot? No idea. Okay, we covered that topic last week. Can anyone try? What is it? It is actually a very important concept in interest rate. Okay. 민산, 손민산, right? Yeah. 박민산, sorry. Do you want to try? What is term structure of interest? What does it mean?
Structure of interest rate.
Yeah, term structure of interest rate. Yes.
Is it the calculation we learned last week or just the terminology?
You can just expect terminology.
Because of the time value of money as the expected cash flow. We can expect the cash flow, but we have to the future cash flow have to be divided by the interest rate to become the present value. So that's divided by this interest rate.
Okay. Actually, term structure of interest rate is very easy. The shape of yield curve actually. Right? And what is yield curve? Yield curve is simply x-axis is maturity and y-axis is spot rate. So it basically tells you how interest rate changes as maturity changes. Okay. Let me check the Google. What web? How Google defines term structure of interest rate. Okay. So term structure of interest rate. Sorry, today we have lots of technical problems. It is simply term structure interest rate is related between maturity and interest rate, and usually we describe term structure with yield curve. There is several ways to draw yield curve. One way is through yield curve to describe the relationship between maturity and short rate. Actually, spot rate. Another way is actually we can use forward rate instead of spot rate to describe the term structure, because as I explained, spot rate and forward rate contain exactly same information. If we have one, we can recover the other. Then the question is, what determines the term structure of interest rate? Okay. Just in case, let me check one more. Okay. For me, can you explain what is forward rate?
Forward rate is the interest rate at which it will be traded, or the interest rate that will be prevailing in a future period sometime. For example, if it's a 3-month forward rate, then that's the interest rate that will be prevailing in the market in 3 months. Well, presumably.
Okay, that's exactly right. Angelica, do you know how we can calculate forward rate? If we know spot rate, how we can calculate forward rate? No. What is your name? Okay. Hourly. So, how can we calculate forward rate if we know spot rate? You guys try. What's your name? Oh, absolutely. Yeah.
I'm not there, but I think there's another formula or something.
Yeah, it is formula. Yes, there is formula. There's one relation between pathway and forward rate. The intuition is maybe so important. But anyway, you can say formula or intuition, whatever you want.
I have no intuition.
Okay.
I don't remember the problem.
Okay, let me start with the spot rate. So spot rate is the interest rate charges for lending money today until period T. So it is a discount rate. So it is basically $1 value at time T. Okay. So $1, it is a value of contract which pays you $1 at time T. Value of contract today. And spot rate is simply 1 plus spot rate and then multiplied by T and divided by 1 over 1 plus spot rate T to the power of T. So it is like per period interest rate, okay, to discount the time value of money. Usually T is like annual basis. So if it is half year, T is 0.5. If it is 3 months, T is 0.25. So it is spot rate. And if we know spot rate, then we can recover forward rate. We can recover forward rate by this formula. So it is a formula when we give a discrete rate. Okay. Yes. Okay. Let me use this one. So it is forward rate when we have a discrete compounding. So forward rate is basically interest charged at time alpha. Okay, alpha, and interest charged for the lending contract or borrowing contract from alpha to beta. Okay, so it is interest rate, not prevailing today. It is the interest rate that will be charged loan at time alpha. Obviously, we can recover this forward rate by combining two spot contracts. To know the interest rate between alpha and beta today, okay, the forward rate is determined today. So we can simply manufacture forward rate, forward contract. What we can do is we can borrow money, okay, for the entire period. And then we can lend money for this period. The different rate of the interest rate, the difference between the two is simply forward rate. Therefore, if 1 plus S beta or beta, power of beta is simply interest rate. It is the amount of money you have to pay at time beta, right? If you buy money, if you borrow $1 today. And then actually, borrowing $1, there are two ways. Okay, two ways to borrow $1. One way is simply borrow $1 and pay at time beta. Another one is you can simply borrow money today and you promise you will pay back $1. Okay, the dollar and the interest rate at time alpha, and you can make a forward contract today between alpha and beta. Simply you can rule over the contract. That is this part. And that two contract exactly same. It should generate exactly same value. The value of the two contracts should be exactly same. Therefore, the forward rate should be like this. And the short rate is kind of forward rate. Okay. Forward rate per period. So it is a forward rate at time alpha, and the short rate at time alpha is simply forward rate between alpha and alpha plus 1. Okay. And short rate, we will learn more about short rate later on. And short rate process, okay, the dynamics of the short rate is very important to model the interest rate process. Now, the question is, what determines the term structure of interest rate? Okay. Okay. What determines the shape of the yield curve? There are three stories about the term structure of interest rate. First one is liquidation hypothesis. So they say that forward rate of the future. Okay, forward rate. They argue that forward rate, which is the basically lending contract for the future. This hypothesis that forward rate is basically expected spot rate of the future. Okay. So in this example, okay, forward rate, we know forward rate, right? We can make agreement today that how much I have to pay and the interest rate if I borrow money at time pay back at time later. We make agreement today. We make a borrowing lending contract today about this transaction. But and the question is how that forward rate, what does it mean? The expectation hypothesis says that okay, if we can make agreement today to borrow some money between alpha and beta, that means that interest rate must be the spot rate and will prevail at time alpha. Okay.
Can you please explain again?
Yes, so forward rate is, okay. So again, let's go to 신한bank example. Last week I used. So suppose you need the money 1 year later. Yeah, not today. Suppose you need the money 1 year later, and you are willing to pay back the money 2 years later. Okay, so you don't need the money today, but you will need the money 1 year later, and you will pay back in 2 days later, 2 years later. Okay, and then, okay, in that case, okay, you may want to know what the interest would be. Okay, usually bank does not let you know, okay, what would be that kind of interest rate, but actually that kind of interest rate can be easily replicated by spot rate contract, as I explained. So anyway, if you need money 1 year later, and if you want to pay it back 2 years later, there must be some interest rate that you can determine today. Okay. So suppose 신한bank implicitly say that, okay, you have to pay like 10% of interest rate if you need money 1 year later, and you will pay back in 2 years later. Okay, so let's make that interest rate 10% today. You can make agreement with 신한bank today, and then expectation hypothesis. Okay, expectation hypothesis means that 10% interest rate you make today is the expected interest rate. Okay, market expected interest rate that will be applied in actually 1 year later. Okay? So 1 year later, suppose 1 year later, and then 1 year later you can go to the bank again, and then actually you can borrow money at that time, and you will pay back money in 2 years later. Okay, not today, but 1 year later, and then at that time there must be the interest rate that you have to pay. Okay, of course, since you are today, not 1 year later, so you don't know that interest rate. But expectation hypothesis means that that interest rate, which will apply in future as spot, the future spot, the expected value must be the forward rate available today. Can you understand? So, I mean, yeah. So you know the difference between spot rate and forward rate, right? So let me see the formula. Okay. So expected hypothesis means that forward rate, okay, it is interest rate that is charged 1 year later, from 1 year later to the 2 years, right? For 1 year contract from 1 year later, right? That must be the expected spot rate, interest rate at the spot 1 year later at the time. So 1 year is starting from 1 year later, and you have to pay back 1 year later at the time. So from today it's 2 years later. Does anyone have a question? So again, expected time, it is very important. It is, they said the forward rate is basically expected spot rate. And liquidity preference means that the yield curve is determined by basically people's preference over, okay, liquidity. So liquidity preference means that people prefer cash, and people generally don't prefer the contract that pay you cash sometime later. Okay, so what does that mean? It means that if people tend to prefer cash today, then basically cash has zero interest rate, right? Okay. And if we want to make people hold the long-term contract, long-term bond, it means that basically we have to pay high interest rate. Again, which means that if we wanna pay, if liquidity preference hypothesis is right, okay, if we wanna receive $1 in 10 years later, then the spot rate for that 10-year contract should be lower than the spot rate for the contract which pay you $1 maybe in 5 years. Okay? Because $1 in 5 years is closer to the cash in some sense. Okay? So liquidity preference hypothesis means that yield curve should be upward sloping. Okay? And actually that's the usual case. Usually yield curve slope upward. Market segmentation hypothesis that long-term bond or short-term bond or long-term interest rate or short-term interest rate is determined, okay, separately. Okay. Third hypothesis, this is not that important, and these two are kind of important. Let's go over the expectation hypothesis again. If we believe expectation hypothesis, okay, suppose expectation hypothesis is right, such that forward rate is simply expected spot rate of the future. There is actually a problem. There will be a problem. What do you think it should be? It would be. What would be the problem of expectation hypothesis? If forward rate is simply expected spot rate in the future, what is the problem? Okay.
Randomness.
Beg your pardon?
Randomness, errors.
Yes, error test doesn't matter. Of course, if forward rate, so that's why it is expected value. Right? So maybe in future, this hypothesis says that maybe in future the spot rate in future may be higher or lower than forward rate which is available today. That's possible. But what it basically says that maybe it is low, but on average, okay, on average, okay, it is a rough statement. But in expectation or roughly speaking, on average, forward rate should be right. That's what this hypothesis says. So there is always error. Okay, there is always error. But error, the positive error or negative error always balance. So on average, this hypothesis says on average this is right expected value for the future possible. Okay. Can anyone guess what would be the other problem? Yes.
I have a question. For example, unexpected events, like for example the earthquake in Japan, is going to influence the forward rate?
Of course. That's an interesting question. Okay, let's discuss it more. Okay. Because of the earthquake in Japan, how will it affect forward rate? Okay. Can anyone tell me how do you think it will affect Japanese forward rate? The more accurate question is actually about yield curve, but let's focus on the forward rate in future. Okay. How will it
It's going to
affect?
be less than the expected one?
Beg your pardon?
It's going to be less than the forward rate we were expecting.
It will be. So forward rate is you can observe forward rate today. Okay. You can observe forward rate. So correct question is if Japanese earthquake, because of Japanese earthquake, how forward rate will change today? Okay. That is the correct question.
Maybe forward rate will drop because rate, so we need to decrease further. And plus with all that unexpected events that might happen in the nuclear plant, so it's kind of vague. But from what government is doing, I think pretty much it will be lower than the prevailing.
Interest rate.
Most probably.
What do you know what is Japanese interest rate is now?
It's almost zero from what I read.
Yes, it is
almost
zero. It is not almost. It is basically zero. Okay, practically zero. So how can we lower interest rate below zero? Is it possible? So I mean, more rigorously speaking, spot rate is zero. Okay, Japanese government rate. Okay. It is called a JGB. Okay. It's called a JGB. So interest rate on JGB, or the interest rate that government control for JGB is practically zero right now. But it does not mean that forward rate that is, if we believe expectation hypothesis, it may be the expected value of the future interest rate. It does not mean that that will be also zero. Even if today, although today the spot rate is close to zero. Short-term spot rate is close to zero. Okay. Let's think about this more. Okay. I'll give you the answer later. But let's focus on the expectation hypothesis. So what would be the problem of expectation hypothesis? X-axis is term structure of interest rate, and suppose Y-axis is the spot rate. So what is the usual shape of the yield curve? It looks like this. Okay. If spot rate looks like this, okay, we can draw yield curve another way. T, and let's say T forward rate. So if yield curve about spot rate looks like this, and what would be the shape of the forward rate? Downward. Okay, so it means like this. Again, let's go to our formula. Okay. It is very important. Okay. Let's go to our formula. Okay. So our formula for spot rate, the relationship between spot rate and forward rate looks like this. And if the yield curve about spot rate is upward sloping, okay, then if beta is greater than alpha. Okay. And if we compare S alpha and S beta, what should be higher? Which one is higher, S beta or S alpha? S beta is higher, right? S beta is higher. Okay. And if we have higher S beta, the larger S beta, which means that given S alpha, if we have higher S beta, then we have higher value F alpha level, right? So the larger future spot rate is long term, okay? The larger we have forward rate. This is mathematical related. So basically, which means that if spot rate at this time, if we compare these two spot rate, if this is greater than this one, the forward rate between the two periods should be, forward rate in the distant future should be higher. Right? So if yield curve looks like this, then forward rate, of course, should be looks like this as well. Actually, let me be more accurate. Okay. So the initial starting point should be same. Forward rate today between today and tomorrow should be the same to spot rate today and tomorrow, right? So starting point should be same, and forward rate should be upward sloping. And then my question is whether the slope should be either higher or lower than this one. So suppose it is a spot rate. Okay, it's spot rate. Actually, let's use this chart. So because of the mathematical relationship, now we know spot rate should be upward sloping. Forward rate also upward sloping, and the starting point of the forward rate, okay, should be the same to spot rate. And then my question is upward sloping, but do you think it should look like this or look like this?
Lower than spot rate.
This is 1, 2. Okay, could you please raise your hand if you think 1 is right? Okay, could you please raise your hand if you think 2 is right? So majority has no opinion. Okay, okay, Yongwon, why do you think 2 is right?
Spot rate curve is actually upwarding, but the slope is decreasing, and future rate is the difference between spot rate, 2 point of spot rate, and difference will be decreasing because
So you are thinking of a second order, second derivative of the. Okay, Bauta, I think you support. You think this one is right? So can you explain?
I support 2 as well.
Oh, you think this is right?
Yeah.
Okay, who think? Okay, how about I forgot your name. Yeah, Kenny, why do you think first one is right?
Because spot rate is increasing, so forward rate means like we expect the future rate will be like this, so it is increasing, so the slope will be steeper. Maybe. I don't know.
So actually, you are right. Slope should be looks like this. Okay. So and you have very basically right, but not that specific. So can anyone just try to intuitively why this first line would be the forward rate curve? Okay.
I also think that one is correct, but my explanation was a little bit more simple. I was just thinking that if we take the 2 points and just put them from the beginning, it's becoming like more steep curve.
That's right. That's exactly right. So spot rate is basically average, right? Average in some sense it is called a geometric average. Okay. Geometric average, not mathematical average. Arithmetic average. It is basically average of interest rate between the two curves, right? And if that average is increasing, okay, over time, if that average is increasing, which means that if we add more and more interest rate on, there should be higher value, right? Therefore, and forward rate is interest rate in the future. If we recover forward rate by the relation of the spot rate, it is basically geometric average between spot rate and future forward rate is today's spot rate. Right? Therefore, if spot rate is upward sloping, then the future interest rate basically should be higher. Right? So therefore, forward rate curve should be even steeper. Which means that, okay, if term structure of interest rate in terms of spot rate would be look like this, then forward rate curve should be look like this. Okay, so let me go to our original question about the problem of expectation hypothesis. Usually, it is not always, but usually, spot rate looks like this. Okay, which means that since the spot rate is upward sloping, forward rate curve should be upward sloping as well. Okay, so usually forward rate curve looks like this. So if forward rate curve looks like this, okay, if forward rate curve is upward sloping, then what does this expectation hypothesis says about future interest rate? Future spot rate. If we believe expectation hypothesis, what does it mean? Lina. Yeah. So suppose forward rate is upward sloping, and if we believe expectation hypothesis is right, such that forward rate we can observe today is expecting spot rate of tomorrow, what does it mean? What does upward sloping forward rate curve mean?
I don't know.
I mean, basically it is in some sense total rate. Okay? If forward rate is increasing, upward sloping, okay, then forward rate between today and tomorrow should be lower than forward rate between 10 days later and then plus 1 day, right? Which means that, so okay, it is today, 1 year later, 10 years, and it is 11th year. Okay, if forward rate looks like this, the spot rate of today, okay, should be lower than in expectation. Okay, people expect spot rate in the future would be higher than spot rate today, right? Right? I mean, it is what this hypothesis means. But this hypothesis means that high forward rate means that people have expectation about high spot rate tomorrow. And the expectation hypothesis is right. It means that spot rate should always increase as time goes by. Okay. And is it true? Should spot rate? So borrowing $1 today, okay, from the bank would be always cheaper than the borrowing $1 like 10 years later at that time. Or 1 year later at that time. We don't know, right? 1 year later, maybe Bank of Korea will lower interest rate. Okay. Who knows, right? And yes, so basically, if expectation hypothesis is right, upward sloping yield curve means that spot rate should increase consistently, but that is not true. Therefore, there is something wrong in expectation hypothesis. So, in order to explain this upward sloping yield curve, we need another step, which is inconsistent for us hypothesis. So, those two hypotheses are perfect to explain the term structure of interest rate. Any question? Yes.
What did you say about the question you asked?
Yes, my question is, what is wrong with expectation hypothesis? Okay.
Oh, you said whether the spot rate will always increase if you said that?
Yes, so if expectation, yes, exactly. If expectation hypothesis is right, and since we can not always, but we usually observe upward sloping spot rate, which means upward sloping forward rate curve, which means that spot rate should increase as time goes by. Okay. And that is not true in real life. So, which means that there is something wrong with expectation hypothesis. Okay. So, this hypothesis is not correct empirically. The data reject this. Since data reject this, since spot rate does not always increase. Any question?
Sir, would it be correct to say that spot rate is actually dependent on the inflation rate? Because depending on the inflation rate, the central bank will actually be regulating the interest rate, right?
Yes.
So on which the spot rate is actually based? Is it correct to say that it's kind of related, or when, for example, forecasting forward rate, one should assume the expected inflation or some other factors?
That's a very tricky question. So, of course, government try to control spot rate. basically there are two types of, not several types, but there is a real interest rate and nominal interest rate, right? What is the difference between real interest rate and nominal interest rate?
Real interest rate is adjusted to the inflation.
Okay, so, we cannot, let me try again, just get Fisher equation. Now it works. It's very strange. Okay. Fisher equation, okay? So Fisher equation approximately means that nominal interest rate is a sum of real interest rate plus inflation expectation. So it is continuous compounded interest rate, and for discrete interest rate, this is usually the Fisher equation. So Fisher equation means that the nominal interest rate which we can actually observe from the market, is the sum of real interest rate and then inflation expectation. Okay? And about government control, actually I think that is a very good question. Okay? So there is a real interest rate and there is nominal interest rate. And there is a short-term interest rate, a long-term interest rate. So there are basically four classes of interest rate. Okay, short-term real interest rate, long-term real, and then short-term nominal and long-term nominal interest rate. What government usually control? Okay. Short-term what? Nominal or real? Yeah. So this is what usually government control, right? So government can control, okay, short-term interest rate, basically. Actually, I need another dimension, but let me stick to this. Okay. Government can control, government target, okay, short-term interest. In USA, it is basically federal fund rate. They target short-term nominal interest rate. Okay, so they can control short-term interest rate for a short period of time at least. Okay, so this is what they can control. Okay, but long-term, how about long-term nominal rate? Can government control this?
Controlled by speculators.
By speculators. So I mean, actually government can control this even for a short period of time, about nominal, but usually it was not the target of the government. Okay? Federal fund rate is government, US government or Korea or Japanese government, they usually do not target this kind of long-term nominal interest rate until financial crisis. Okay? So this is usual, they control usually open market policy, okay, open market transaction, and it was until now, until financial crisis, at least in United States, it was not the target of the policy target. It was not target rate in some sense. But after financial crisis, since it is almost close to zero, they have to do something about this as well. And we call this kind of policy as quantitative easing. And I think you all heard about quantitative easing, right? Does it answer your question?
The question is that is simply inflation rate and spot rate is in a way dependent on the expectations of inflation, right?
Yes, right. So my answer is that it depends on what spot rate. Okay. Real spot rate or nominal spot rate, or spot rate for short period of time or spot rate long period of time. It depends. Any other question? Anyway, if we know the yield curve, then we can calculate net present value of cashes with this MPV formula. So let me. So suppose there is cash flow. Suppose there is a contract that pays you cash flow like A1, A2, A3, A-T, and 1 year later, 3 years later, and something like this. Then in order to calculate the value of that contract that pays this kind of cash flow, if we know the term structure of interest, we can calculate, okay, present value of each cash flow. Okay? Then the value of that contract is simply sum of this value of each cash flow. And the value of each cash flow is simply AC divided by 100, cost of the capital, for that period. And actually this part is simply value of $1 at T times value, which is this part. So, A is any cash flow. Yeah, cash flow 1 year later. So A N is cash flow at time N, which can be positive or negative. Okay. So we call this formula as a net present value model, or discounted cash flow model. Now, let's do some practice. How we can calculate? How does one can compute the yield curve? Suppose we can observe this kind of data about bond. There are 5 bonds in the market. Face value is all 100, so which means that face value is 100, principal is 100, so which means that this bond will pay you 100 at maturity. This first line is the maturity. Oh, this is the maturity. So second column is the maturity. So principal 100 means that 3 months later, this contract will pay 100. Okay? Half year later, they will pay 100. 1.5 years later, they will pay 100. Okay? In addition to that, some bonds have annual coupons. Those 3 doesn't pay you any coupon, but this fourth bond, which promise has annual coupon of 8, which means that in addition to the 100, which they will pay 1.5 years later, every year they will pay you $8. More specifically, in bond contract, they pay you every 6 months, which means that since they pay you $8 per year, which means that every 6 months they pay you $4. So it is basically a contract that promises you to pay $100 1.5 years later, and every 6 months they will pay you $4. Likewise, this one, they pay you $100 in 2 years later, and they will pay you $6 every 6 months. Okay? Then what is the value of that kind of contract? We have a promise. And from this information, what will be the, how can I calculate yield? Okay? How can I calculate yield? It's very simple. Okay? Basically, if we use continuous compounding, basically present value of any cash flow looks like this. So basically, if we have, so F, suppose F is like terminal cash flow, if it is the principal value, and dt is maturity, and this part is the present value of the principal. Okay? And this part would be the present value of the coupon. And we can simply apply this formula to calculate bond price. Any question about this? So you all know the exponential function, right? You all know the difference between discrete interest rate and continuous interest rate. Could you please raise your hand if you don't know the difference between continuous compounding and discrete compounding? Okay, you don't know. Then I have to explain the difference between discrete and continuous compounding. That's not difficult. Okay, that's very easy. Okay, so today, what is today? And it's a t times later. Okay, it's t. Okay, and suppose okay, let's make it t, big T. So spot rate. Okay, suppose no, it's not even the spot rate. So suppose interest rate, one discrete interest rate between this whole time, let's say it is R. Okay, it is R. Which means that if you borrow $1 today, if you borrow $1 today, if interest rate is R over this period, how much you have to pay back? Okay, if interest rate between these two periods is R, okay, and if you borrow $1, how much do you have to pay it back? Yeah, 1 plus R, very simple. 1 plus R. Okay, and this is the one way to calculate interest rate. But there is another possibility, such that okay, although interest rate is R over this period, maybe we can calculate interest rate 2 times. So suppose this is half the time, okay, 2 over t. Then alternatively, what we can do is, okay, we can charge interest rate this period like R over 2, and this period at R over 2, like this. Okay, if we borrow $1 today, and if we do compounding like this 2 times, okay, how much do we have to pay at the terminal date? Nina, how much do you have to pay back? Thank you, part 1 plus R over 2.
Minus T.
Okay, actually this is right. So let me do the step by step. So if we want to calculate interest rate 2 times. So if we borrow $1 today, which means that they will calculate interest 1 time at this period. So interest rate between these 2 periods is R over 2, right? So at this period, we have to pay 1 plus this amount at this period, right? And this will be the now new starting point, and over this period, again interest rate is R over 2, right? So which means that at this period, we have to multiply 1 over R over 2 and 1 over R over 2. So it will be 1 over R over 2 to the power of second. Right? And actually we can do more things. So in general, suppose we divide this as n period. Okay. So this is 1 and this is like, so there is n step. So every n step, every step, we want to pay something like R over n. Okay? And if we borrow $1 today, then how much do we have to pay back? I mean, you can use the same logic. So every period, okay, it grows the factor like this. Every period, this $1 grows by this factor. So at the end, if we do this kind of compounding, we have 1 over R over N power N. Right? Any question until now? And actually, we can do this kind of things extreme, such that, okay, such that we wanna do 1 over N, R, N, and you can make this infinity. Okay. What does that mean? Okay. Can you explain? I cannot read your name plate. Okay. What's your name? Yeah. Please write down your name large so I can read it. Okay. What is your name? What does that mean? If it and to infinity. Beg your pardon?
Like there's no maturity.
This is basically maturity. T is the maturity.
That will mean that the money will be compounding so fast, like every second, millisecond, or...
Yes, so it means that theoretically we want to calculate compound every second. Infinitely often. Okay. And that sounds extreme. Okay. And of course, I mean, if we compare number between this and this and this, okay, this one should be greater than this one, right? This one should be greater than this one, and this one should be greater than this one, right? Because they compound, okay, more often. So given interest rate per period, since they compound more often, okay, this should be higher than this one. Okay, it's very easy to prove. Anyway, this means that we want to do this operation infinitely often. Okay, so we compound every second, every moment. And this sounds like extreme, but actually it is not extreme. So mathematically, we can write this as exponential of the R. It converges to exponential of R. Okay? And this kind of interest rate sounds extreme, but this is actually, so we cannot actually observe this kind of a contract, but this kind of interest rate is more popular among the traders or quantitative analysts in investment bank because this is so easy to handle. So basically this is a mathematical concept. So in investment bank, like traders or quantitative analysts, usually we can observe like discrete interest rate, right? 1 year interest or like 10-year interest rate. What then analysts do is like suppose 10-year interest rate is R. R is suppose is 10-year. Okay. Suppose R is like a 10-year interest rate. So which means that 10 years part rate. So which means that 1 plus R 1, which is the value of the $1 in 10 years later. Something like this. Okay. And what traders usually try to do is they try to find equivalent interest rate. Okay. Continuous compounded version of the equivalent interest rate of X. So yeah. In the case, okay, and we have to multiply by 10. And they want to calculate this because this kind of interest rate is so much more easy to handle and easy to analyze. So basically it means that 10 equal to expectation of X 10. And of course, we can get rid of this one in this case. Okay. So then x is basically so in investment banks, like traders, when we have this kind of discrete interest rate, we usually transform to the exponential continuous interest rate, and we do the option pricing, and we do the everything. And do you know why this type of exponential function is convenient? So anyway, let me so explain this one again. So this means that, okay, so it is R is interest rate for 1 year, and X is, so it is discrete rate, and X is equivalent interest rate. Okay, so assuming that they will do the compounding every moment, and basically we want to have the same value at future. Okay, suppose we want to have the same value in the future, whether you have discrete rate or discrete compounding or continuous compounding, then what would be the continuous compounding rate? Okay, then we have to solve this equation. Okay. And do you know why this kind of continuous compounding is very popular in practice? Can you answer? Why do you think this is exponential?
Because they trade on very short notice.
That's actually right. Because traders trade so often, like daily, or even like several times per day. In that case, okay, if we use continuous rate, actually that approximates the cost of capital, okay, opportunity cost of a very short period of time. So it is very good approximation. And what is another reason? I'll explain to you later on, but I think there is a very interesting thing about this exponential function. If we take a derivative of this one with respect to x, then it simply is so if you differentiate yourself, it becomes u again. Okay. But this property is actually very convenient in practice. So could you please raise your hand if you have engineering background? Okay, you are from engineering department. Who else? Okay. Why don't you prove this one? Okay. Can you prove this one? Why differentiating exponential function equals the same? Can you prove that? Long time ago. So you forgot now. Why don't you try?
I forgot to.
You forgot to. Byung-chul, did you forget it?
I'm not sure, but I'll try it.
Okay, why don't you try? Yes. And I want to spend more time about this exponential function because we will have this function over and over again during this class. And when I say interest rate, usually if I don't specify separately, it is usually, it should be a continuous interest rate. So when I say interest rate from now on, you can simply assume it must be continuous rate. Okay, and then, so that is the definition of the differentiation. Okay. Actually, I'll do that because it is hopeless. Of course, it is the definition, and it should be the this one. If you do the work, then of course you can do it, but it will take a lot of time. Okay. Actually,
I think like you mentioned about explanation about continuous, so it turns out doesn't matter if you try to calculate the slope or just itself.
So that's approximately right. Okay, but I want a mathematical proof about that. Right? So this is basically, so you all know it is the definition of differentiation, right? If you learn calculus in high school, you should know this. So it is differentiation definition. But, and of course you can prove. Okay, you can prove like this. But actually there are easier way to do it. Well, okay, we have this log function. Okay, then is another explanation. Okay, we will use log in this class a lot as well. In high school, when we say log, usually the base is 10, right? Do you remember? Okay, the base is 10. But in college, in finance class, or any advanced class, okay, when we say log, it is usually the base is exponential. Okay, in Excel, it is open written as this one. Okay. So from now on, whenever in the textbook or everywhere, whenever you see log without any basis, you can simply say that you can simply think the basis is exponential value, e, not 10, okay? In this case, okay, in this case, so basis is exponential, and if we do this one, what should be the value of this one?
X.
Right, x. Right, because log some a and a over t should be t. High school math. And actually it is also easy to prove, but I'll skip this. And let's take differentiation of each side. And what it should be? Maybe it should be 1. Okay. It should be 1. And then the question is how we can take differentiation of this one. That's why we need another explanation. Okay. Do you know what is this? Okay, this is 1 over x. And it sounds so, again, the base is e. And then, again, this is again easy to prove, but I don't want to prove it even this one. So why don't you can just simply memorize this one, okay? Because I don't understand this one. So let's use this formula, okay? Then, okay. Let's move with one function and this is another function. So basically this is the basic differentiation of this one. And by the chain rule, okay, this looks like f prime and g prime x. Right? So this is a chain rule. So okay, it looks like this. Okay. So you remember this one, right? Chain rule of the differentiation. And actually we can apply formula here. Okay. So about this part, okay, this part is simply, okay, which means the differentiation of a log function and then differentiation of exponential function. and differentiation of log function looks like this. So basically this part is simply 1 over exponential x. Right? And by multiplying exponential x each side, we have this.
Can you repeat it a little bit more slowly? One more time.
Okay, one more time. Okay. Anyway, we will cover higher level calculus shortly, so you should know this kind of operation. You will do this a lot later in more advanced problems, with more advanced problems. So again, let's go with high school calculus. Right? Do you remember this? Right. So it is called the chain rule of the differentiation. And then suppose f y is log y, okay, and g x is exponential of x, and then log exponential of x is simply is combination of simply we can recall this on y, and basically f gx it looks like this. And we want to take a differentiation of this function with respect to x. Okay. And first, because of the chain rule, okay, this must be a log part of the differentiation and exponential part of the differentiation because of the chain rule. Okay. And log part of the differentiation is simply 1 over y. Okay. And this part of the differentiation, something we are curious about, right? And since this part is equal to x, okay, and this should be equal to 1, right? Because log x is x, right? So differentiation of x, so this one should be 1. So this should be 1. Right? And this y is in fact exponential of x, right? So y is exponential of x. So therefore, by multiplying y each side, we have exponential of x equals to exponential of x prime. Any question? Is it, Angelica, is it clear now?
More or less.
Okay. Okay, so for you, I have one practice. What is this?
2.
Okay.
2 divided by y multiplied by the derivative dx of e to x.
No, you are almost right, of course. Right? You are almost right. Okay. So again, we can use this chain rule. Okay. We can use a chain rule. So let's call this one as a y. Okay. Right. Another function. So basically, we have. Okay. First, we have to differentiate this whole part, right? And this whole part is again same, and we want to differentiate this part separately in this two. Right. You are almost right. Any other question? And this is actually very convenient. It is very convenient. Okay? Property. So it is another practice work. Can anyone calculate this? Actually, I'm also get confused. So, even I forgot. Okay. So this is true. Am I right? 병철, am I right? I forgot high school math. So this is true, right? Right, it is right. So basically, this one is simply this one multiplied by x, and this is x. Right. So if we know this kind of property, we can even do the differential of this one. Because e to the power of x looks like this. And by using chain rule exactly the same way, and therefore we can do the calculation of this. Okay, so anyway, that is very convenient problem. So any other question? So again, any question about exponent? Okay.
I have a question about the exponential order. Can you go back the previous page?
Okay.
If you use a financial calculator, it's going to be like present value is going to be 97.5, and then we have future value 100, and n is going to
For
be
some interest rate, okay? For some interest rate, yes.
So how are we going to put like this one in a financial calculator?
In the financial calculator, it depends on which financial calculator you use.
Okay, Texas Instruments.
Texas Instrument, which is the CFA calculator. Okay, I don't know, I forgot. But if I have a calculator right now, I'm pretty sure I can do that.
Okay, but can we use the calculator on our final exam?
Final exam? Yes. Our final exam is likely to be take-home exam, so you can use any kind of...
Okay, so next time if I bring my calculator, I will explain it.
Professor,
No problem.
Will you give us all these calculations, mathematics, all things in exam?
No.
In exam? Not mathematical. But I think maybe you have to understand this in order to solve my problems. I don't make problem out of these simple maths. They are too simple for the smart people like you.
So don't give it to the exam, otherwise I need to make expensive calls to my high school teachers.
Okay. Okay. Anyway, you already know our midterm exams, right? You already know my midterm exam, and midterm exam apparently does not include any kind of result, right? So
We hope it's going to be the same for the final exam.
final exam. Okay, I think about this. Think about that. 97.5, which is satisfied 100, which is the base value. People will multiply by discount rate. And of course, we don't know this discount rate because we don't know the spot rate. But we can calculate the spot rate because we have one equation and one unknown. Right? And therefore, okay. Yeah, therefore, we want to calculate this part, then we will explain the part. So first we want to divide each side with 100, and then let's do this one only. Okay, 97.5, which is 100 exponential of minus -1/4 and some s to 5, and we want to calculate it. And then to calculate it, we want to divide each side by 100, and we want to multiply each side by 4. -4, and we have this one, right? And we have to solve this one. And as I expressed, we can simply use log function, so it is log So in order to know the exact answer, you can use R or Excel. Okay? In Excel, the log function with basis exponential is simply ln. Therefore, we wanna do like ln and then multiplied by minus 4. Okay, which is about 10%, 10.13, yes, approximately. And 13. So please remember, in Excel, log with basis exponential mathematical constant is ln. If you simply write log function in Excel like log, it is log function with basis 10. Okay, and I'm pretty sure that you will not have much chance to use actually this one. Okay. Instead, you will use more of the ln in Excel. And in R, of course, we can do this calculation in R. So let's in R, we don't log is simply log function with basis mathematical constant. So 7.5 divided by 100 and multiply minus 4. Yeah. Yes, even same. And about second bond, it is almost similar. Now the price of the bond is 94.9, and face value and maturity is 6 months away, and we want to calculate the spot rate. And by solving this one, as before, we have 10.07. So we can draw the yield curve. The yield curve, first one is 3 months, right? 3 months. Second one is 6 months. And first one is like 10.13%. Second one is 10.47%. We have 2 points. There was third one, okay. Bond number 3. Okay, it is same. It's 1 year away, and to the calculation we have 10.54. Okay. Now next one is slightly tricky. Now we have coupon. Right? So basically we have to calculate present value of each part of the coupon. But we know the amount of the coupon, and we know when we will receive the coupon. Therefore, the first coupon we will receive 6 months away. And of course, to calculate the present value of the cash flow 6 months away, we have to know spot rate over the next 6 months. And it is the cash flow, present value of the cash flow for 1 year away. Looks like this. And this is face value 100 plus last coupon, which should be 4, right? So the last cash flow should be 104, and we have discounted with the spot rate for 1.5 years. So we have to calculate that. And fortunately, we already calculated this number and this number, right? Which is the this value and this value. Right. So by plugging this number and this number, with 2 this and this, now we know. So we have again only one unknown spot rate and one Q. So we can solve this. By solving this, so 1.5 year is and okay, do on and on, one and on. Then you will have equal pi to the extrapolation. So it's the one way to figure out term structural interest rate given the price of the bond. Continuous compounding, we already learned. Any question? Continuous compounding to calculate forward rate as well. And previously, we know we can calculate forward rate this way. Right? So again, I will explain this one. This is the 2-year contract, and this part is for replicating this 2-year contract with 1 year each. 1 year is part A, and forward rate for the next 1 year. So this is the formula already we know. And if we use continuous compounding instead, okay, this one plus continuous compounding for the continuously compounded forward rate between 1 and 2 years looks like this. Okay, so we have to use the exponential function. So yeah, this part is transformed into this part. Likewise, this part and this part, we have this one. The solution is forward rate is therefore by taking log each side, we have this one. So very convenient if we continuously compound interest rate, we have this simple linear relation between interest. I mean, if we use this notation, actually it is now more clear because continuously compounded interest rate, okay, is basically it is a relation between arithmetic averaging, right? So rate is basically average, arithmetic average between the two rates. And it is actually then more clear why we have a steeper forward rate curve if we have upward slope yield curve. Any question until now? Now, until now, we have in term structure of interest rate about basically risk-free bond. We don't take into account any risk. Risk of bond means risk of default. Default means risk of not paying either coupon or face value. So we didn't take into account the possibility of default. But if we consider the likelihood of default, then of course we will require higher yield. Okay, basically we will require higher interest rate to the bond because that bond is likely to default. In the case we will lose money. Right? So bond yield for the risky bond, we will require some additional rate over spot rate, and that additional rate is of course depends on the quality of the bond, which is, of course, the likelihood of the default. Any question until now? Now, finally, we are now about to learn about derivative contract now. Okay. The easiest derivative contract is forward contract. Okay. Forward contract is simply a promise, okay, agreement of each part to receive something in future in exchange to the money. Okay, so for the contract, yes, okay. So for the contract is basically contract to buy or sell a specified amount of the commodity at a specified time t at a specified price f. So simply speaking, at time t, if you are buy side of this forward rate, it means at time t you will pay F and receive something, which is the buy side of the forward contract. or sometimes we can say it is long position in the forward contract. Okay? Long position means you will receive commodity and give out cash. Okay? Short position on the other hand means that you will receive cash and you have to give out the commodity. So there are a lot of examples about forward contract, like a commodity forward contract or T-bill forward contract to contract loan money in the future. Right? It's a very expensive car. So suppose you will receive a Ferrari 1 year later, and you will pay $1 million. Okay, so the payout, therefore, when 1 year later, will be the value of the Ferrari 1 year later, and minus $1 million. If you have n number of Ferrari contracts, then you have to multiply n with it. Any other question? So it is easiest derivative contract. And then next question is, what should be the value of n? Okay. So in order to receive Ferrari 1 year later, how much you have to pay 1 year later? Okay. What is the fair contract? Okay. What should be the fair amount you have to pay 1 year later? Okay. We want to determine that amount today. Of course, you have to remember that it costs nothing to enter into a forward contract, right? Because it is simply agreement with each other. I'll give you Ferrari, and you give me $1 million, right? We make agreement today, and nothing else. No cash transaction each side. But 1 year later, there will be a real transaction. And then to calculate the value of F, the forward price, how much do we have to pay 1 year later to obtain Ferrari? That's very easy to calculate. Based on the definition of forward contract, we don't exchange anything. So today's cash flow is F. But at time T and maturity, okay, you will receive some commodity which value is ST, right? And then you have to pay out. Okay, so it is the payout of your position per contract, right? And in order to cover, one way to cover this position is that since you will have one commodity